Well, good morning, everyone. Today is the 30th of January. Can you imagine? We were just celebrating 2020, and now the first month is almost gone. There's one more day left. It's going fast, folks. Let's talk about the market today. All right, Eurozone. We had the best unemployment data since 2008. This is very positive, and it's the first time we've had such really good news from Europe. I'm very happy about that because Europe has been really lagging against the US economy, and that hasn't been positive, and they've been having negative rates. And what that causes is investors in Europe to shift less money into US because their economy is worth, and that decreases imports and so forth and so forth. So this is a very positive sign. I'm very happy to see that. Now, on the negative side, we had existing home sales the other day, and the numbers were the lowest numbers, the weakest numbers in 9.5 years. Now, remember what I told you when we did the Turning Point webinar last day, December 31st and January 1st or 2nd? I wanted to give you a full prognosis of what's ahead for the year. And I told you guys that the worst sector, in my opinion, was going to be the real estate sector. And right now, just either yesterday or the day before, we had the existing home sales come out at a 9.5 year low. That's almost the levels we've seen in 2009-ish, 2010 and a half. Not good levels. Not good levels. I still believe that the worst sector this year is going to be the housing, the retail sector, real estate sector, not retail, real estate sector. So that's that. Okay, Fed data. Fed talked. They said a couple of things. They're not raising rates. They're watching the coronavirus very, very carefully. Speaking of the coronavirus, we've had up to this morning 7,711 cases and a total of 170 deaths. And it looks like this coronavirus is no longer just impacting China. It's impacting other parts of the world, including some limited cases in the US. I don't want you to panic because these things tend to resolve fairly quickly, especially when there's so much attention being paid to it. But again, it's an unknown, and we have to look at it very, very carefully. Another thing the Fed said that was very concerning. I'm not sure if you guys know this or not, and I have to explain this or not. But back around 2008, when the U.S. economy was in a really bad shape, President Obama and Yellen, who was Yellen was the president of the Fed, the head of the Fed, just like Jerome Powell is right now. And they looked at each other. They said the economy is going to fall apart. We have to do quantitative easing, which means money being shifted from the Fed into the bond market to buy bonds and keep interest rates low. And that's really healthy for the market. When they started doing that in 2008, the value of the global economy doubled. I'm not kidding you. If you look at the global economy, it was at 34 trillion in 2008, and it's like 69, 70 trillion now. U.S. economy is at 34 trillion. The global economy was at 34 trillion in 2008. So this is really important. The Fed put about $60 billion into this quantitative easing last fall, and they just announced that they're going to discontinue or re-examine things in April. That's not positive. That's actually not positive at all. And that's going to create some ripples. As a matter of fact, when they announced this, the stock market started selling off. And that was very, very important and something that we haven't seen in a while. The market's been strong. And now this quantitative easing was what I was hoping would keep the market up. But if they're going to discontinue it in April, that's not great. That's not great. That means they're really focused on economy being strong. Now, if the economy's strong, we won't need it. And if there's no issues with Trump and with the coronavirus, all of this will be for nothing. But this is not positive, and it's taking out what's a good word for it? A parachute. It's taking the parachute away from us, and that's not positive. Now, I specifically wanted to do this report right around 8:30 because I know we had two major reports come out. The biggest report of the year, let's see, of the quarter, GDP. Let's see how we did. Actual 2.1. Now, here's the thing. That means economy is humming along very well. There's no issues. I told everyone who would listen, anything above and beyond 2 is positive. 2.1, That was the consensus. That's the actual number. That's what Wall Street was hoping for. Actually, anything above 2 is good, but 2.1 is telling us that the Fed shouldn't be too concerned about lowering rates, and they're making the right decision. If we can maintain 2.1 over the next couple of quarters, then we're doing better than expected. Now, let's look at another report, jobless claims. I'm not too worried about jobless claims because they've been like at a 50, 60-year low. And again, 216,000, right in line with consensus. These consensus are estimates, and again, you see the range is 213 to 216 new claims. The claims was at 216. I wouldn't make too much of a case about this because this number still tells us that unemployment's near a 50-year low. So I'm not too concerned. The bond market, let's look at the bond market, not really responding too much off this data, rallying just a little bit based on what we've seen because of the coronavirus, the stock market selling off, the latest Fed statement that they're going to put less money or stop putting money into the stock market. And so far, they put about $60 billion into the bond market, which has been keeping rates very low. So there are some concerns, but as of right now, the economy is humming along well. Let's talk about earnings. Microsoft beat expectations. The stock is set to open $6 higher. Not bad. Tesla killed expectations. Up 8, almost 9%, 52 points before the open. This stock is a killer. And I think this year Tesla's going to do really well. I'm staying away from it because it's just too volatile and there's just too much risk. But the stock is back on an uptrend. A little overbought in my opinion, but still doing fairly well. Qorvo, this is a stock that sells chips to Apple. Up 6.87%, killed expectations. So far, tech is doing well. The only negative is Facebook. And Facebook was doing really well, was supposed to take off, down about 8% pre-open, didn't beat expectations, underperformed expectations. But Microsoft, Tesla, Qorvo killed it. I mean, killed it. Did much better than expected. Expect slightly upper, expect a market that's somewhat neutral. I'm expecting the stock market to hit the 50-day moving average. Momentum levels are lower. Let me show you something that I've been trying to show anybody who's been paying any attention to me. Let me show you this. This is interesting. Look at this. This is the percentage of stocks in the S&P 500 that are trading above the 200-day moving average. And about a week ago, 2 weeks ago, when we got up here, I told you guys, I said, look, we are at the highest level we've been in 5 years. The market is grossly overbought. We're due for a sell-off. At that point, 84% of stocks were trading above the 200-day moving average in the S&P, and now it's down to 72, and I believe the number is going to come down to 50 or even 40, which will take the S&P 500. Let me show you a chart so you could see exactly what I'm thinking. I'm expecting us to go to about 2,900 to right around 3,000. Don't think this is going to be a major downfall. It's just a pullback. It's desperately needed. And I think the market is going to pull back very, 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 very soon, or continue pulling back. It can't sustain these momentum levels. And usually when you have over 85% of stocks in the S&P trading above the 200-day moving average, the S&P will resolve by going back to the 50-day moving average. And as I said, the 50-day moving average on a daily basis is right around 3,200, right here, not too far from where we're at right now. I showed you a weekly chart, but this is a daily chart. This is a lot more meaningful. So look at 3,200 as the near-term level. And again, in terms of Tesla, buy signal. In terms of Microsoft, buy signal. In terms of Qorvo, I really like Qorvo because it's been going choppy sideways. It doesn't have strong momentum over the last few weeks, so that means it could really pick up now. I like this stock a lot. It's actually one of my favorite stocks. But stay away from Facebook, at least till we hit the 209, 210 level. Hope that helps. Now, I've got something big for you. Now, I hope everyone had a chance to view the Smart Money Spikes training session that I did with Josh Martinez a few days ago. It was a killer. Like I mentioned, the replay is only going to be up for a limited time. If you want to receive premium trade alerts, the best stuff on earth, if you want to learn how to fade dumb money, you want to be on the smart money, fade dumb money, smart money strategy might be the best thing that's ever come along. There's still 1 or 2 spots left. This is not going to be available. We're going to take it off. And next time you see it, it's going to be about 4 times more expensive. No, I'm not kidding. I really mean that. Follow the link below. Check it out. Few spots left. Folks, this will teach you and show you and give you signals to help you trade with smart money against dumb money. Smart money wins about 7, 8 times out of 10. Dumb money wins about 2.5 times out of 10. You know which side you should be on. Follow the link below. Don't delay. Like I said, the sale price is probably going to be 3 or 4 times more expensive. Do it now. Get in on it before it's too late. Don't procrastinate. The biggest factor that separates winners and losers is procrastination. Give it up. Follow the link below. Talk soon.